OG John AG here. Let's get straight into what's happening. It's genuinely shocking, and you need to understand why. Silver just blasted past $117 an ounce, currently trading around $112 to $130. Gold smashed through $5,000. Palladium, platinum, natural gas, physical hard assets across the board are surging in vertical moves most traders haven't seen in their careers. Meanwhile, Bitcoin, the so-called digital gold, supposedly built for exactly this kind of fiat crisis, is flat at $88,000, sometimes even down, while metals go parabolic. Let that sink in. Silver is up over 270% in recent months. Gold hit $5,100. And Bitcoin, the fixed supply digital asset that every maximalist promised would explode when paper money melted down, can't even hold a rally. This is the fiat crisis Bitcoin was built for, except it's being absolutely destroyed by physical metals. The divergence is stunning. Silver's market capitalization now exceeds Bitcoin's total market cap. A metal you can hold in your hand, dug from the ground and used as money for 5,000 years, is now bigger than the entire Bitcoin network in value during what was supposed to be its moment. Physical premiums on silver bars and coins are spiking as dealers struggle to source material. Bitcoin? $88,000, with billions in liquidations hitting leveraged longs. This isn't a minor gap. It's a total decoupling. So why? The mainstream narrative told you Bitcoin is digital gold. Finite supply, 21 million coins, perfect hedge against fiat debasement. When central banks print money, Bitcoin should moon. Millions believed it. And yet, in a real dollar crisis with commodities screaming higher, Bitcoin is left behind. Here's the reality. We're not in a broad fiat collapse. This is a targeted dollar crisis, and that distinction is crucial. The US dollar is weakening sharply against the yen, euro, and pound. The Federal Reserve has intervened to stabilize currency crosses. Political chaos, government shutdown threats, and trillions in debt-needing rollover are pressuring the system. When the dollar drops, commodities priced in dollars rally: gold, silver, oil, copper, natural gas. Foreign buyers pile in. Domestic holders see purchasing power erode and flee into hard assets. This is a mechanical relationship that has repeated through history. Weimar Germany, modern Turkey, Zimbabwe, and it's happening again. Here as the part that breaks the Bitcoin thesis. Physical hard assets absorb the flight to safety, digital assets do not. In real uncertainty where people question whether governments or banks can pay their bills, investors sell what's liquid, Bitcoin, while hoarding tangible metals. Billions are realized in Bitcoin shorts and leveraged long liquidations, while gold and silver grind higher, pulled off the market, locked in vaults, accumulated. The mechanics are clear. COMEX registered inventories have been under pressure for months. Shanghai gold exchange premiums remain elevated. Retail demand for coins and bars is exploding. This is not speculative froth. It is real accumulation by those who understand what tangible assets mean when trust starts cracking. Here as the reveal, Bitcoin isn't T-failing because it is poorly designed or because of its supply cap. It's failing because it's abstract. You can't touch it. You can T-bury it in your backyard or lock it in a safe and know it is there, independent of internet, power, banking, or regulatory failures. Tangible assets beat digital every time in a crisis. Think about silver and gold, elements of the periodic table, existing independent of governments, networks, or corporations. Silver was valuable in ancient Rome, Imperial China, the California Gold Rush, and it will still hold value a century from now. No counterparty risk, no code vulnerability, no regulatory threat. It just is. Bitcoin, for all its advantages in portability and censorship resistance, doesn't have that same visceral tangibility. In moments of real fear, not theoretical fear, not late-night Twitter anxiety, but genuine fear of systemic collapse, people reach for what they can touch. That's exactly what the market is showing. Technically, silver broke through a massive multi-year resistance zone around $30 and $35 months ago. That breakout triggered algorithmic buying, momentum funds, and technical-driven purchases, pushing silver from $35 to $70, then $70 to $110, and recently spiking above $117. Shorts covering, FOMO buyers chasing, physical premium surging, futures markets dislocating from spot. Gold's rally has been steadier, but just as relentless. Breaking above $2,700 was the key technical signal. $3,000, $4,000, and now $5,000 have been cleared, with weekly RSI still not extreme. This tells us the move has legs. It's not a blow-off top, driven purely by emotion. It is a structural repricing of gold in a world where trust in fiat currencies is eroding faster than central banks can print. By contrast, Bitcoin's chart looks weak, completely disconnected from the tangible asset flows dominating this crisis. It is a structural repricing of gold in a world where trust in fiat currencies is eroding faster than central banks can print. Bitcoin's chart, by comparison, looks weak. The failure to break convincingly above $90,000 while metals were launching was the first warning sign. The subsequent rollover and inability to hold key support around $92,000 confirmed that buyers were in T stepping in with the same conviction. Volume profiles show distribution, not accumulation. Realized profit and loss data shows long liquidations outpacing short covering. This is not the setup you want to see in an asset that supposed to be a macro hedge. But let us be clear. This isn't a claim that Bitcoin is dead or that crypto has no future. That's not the point. The point is understanding what's happening right now. And in this moment, Bitcoin is being treated as a risk asset, not a safe haven. That could change, maybe tomorrow, maybe when the dollar stabilizes, equity markets find a bottom, or regulatory clarity improves. But today, physical metals are winning, and Bitcoin is not. There are legitimate bearish factors for metals. Industrial demand for silver, a key driver of the deficit thesis, could weaken if a global recession hits. China's economy is slowing. Europe barely grows. U.S. manufacturing data is mixed. A sharp drop in industrial offtake would remove a pillar of silver's bullish case. Gold, though less tied to industry, can see profit taking at these levels. $5,000 per ounce is a psychological magnet for sellers. Miners hedge, central banks may slow purchases, and technically, both metals are extended and vulnerable to sharp corrections. For Bitcoin, the bearish case is correlation to risk assets. If equities roll over hard, Bitcoin likely follows. Regulatory uncertainty remains, especially with potential crackdowns on stablecoins or DeFi. The narrative that Bitcoin is digital gold only works if people believe it. And right now, the market's behavior shows that belief is being tested. Now, the bullish counterpoint, the dollar crisis isn't over. It's accelerating. Debt refinancing needs are mounting. Political dysfunction is worsening. And the Fed is trapped between inflation and recession. Every policy move creates new dislocations. Commodities priced in dollars will continue benefiting as long as dollar weakness persists. This weakness is structural, not cyclical. A multi-year trend driven by unsustainable fiscal policy, trade imbalances, and slow erosion of the dollar's reserve status. Physical metal supply is constrained. Silver mine output is not keeping pace with industrial demand from solar, EVs, AI data centers, 5G, and defense applications. The deficit is real. Inventories are falling. Above-ground stockpiles are being drawn down. Unlike Bitcoin, you can't simply mine more silver by plugging in computers. New mines take years to bring online, and exploration budgets were slashed after the last bear market. Supply response is lagging. Geopolitical fragmentation adds another tailwind. China has export controls on critical minerals. The U.S. is reshoring supply chains and imposing tariffs. BRICS nations are diversifying away from the dollar and buying gold. Central banks have set records for gold purchases, and the trend continues. This isn't speculation. It's documented, verifiable activity by sovereign entities managing trillions in reserves. They're buying physical metal, not Bitcoin. Here's the kicker. If Bitcoin eventually catches up, if it starts behaving like the digital gold it's supposed to be, metals will likely rally even harder. The underlying driver is the same, loss of confidence in fiat. A scenario where Bitcoin moons and metals collapse makes no sense. They're both alternatives to fiat. The current divergence is either temporary, with Bitcoin eventually catching up, or it's revealing something fundamental about which assets people truly trust when the system is stressed. Let that sink in. The crypto bell is ringing. Maximalists scream that this is Bitcoin's moment, and yet the buyers are piling into silver and gold instead. They're voting with their capital for tangible over digital, for a 5,000-year track record over a 15-year experiment, for physical certainty over cryptographic abstractions. Does that mean Bitcoin has no place in a portfolio? No, it has unique properties. Portability across borders, divisibility to 8 decimal places, and resistance to confiscation if keys are managed properly. For people in hyperinflating or authoritarian countries, Bitcoin is a lifeline. Those use cases are real, but as a macro hedge in a dollar crisis, the market is telling us right now that it isn't performing the way the narrative promised. Where does this leave us? 3 key takeaways. This is a targeted dollar crisis, not a broad fiat collapse. Explaining why commodities are rallying and Bitcoin isn't. Physical hard assets are absorbing safe haven flows because tangibility matters more than most crypto advocates admit. This divergence won't last forever, but until Bitcoin proves it can store value under real stress, it remains a speculative asset, not digital gold. The unresolved question, if the dollar crisis deepens, debt spirals, inflation roars, or deflation crushes growth, what breaks first? Does Bitcoin finally catch a bid as the ultimate non-sovereign asset, or do metals continue to run while crypto bleeds? Nobody knows. For holders of physical metal, this is vindication. The thesis is playing out. For Bitcoin holders, it's a moment to reassess, not panic, but ask hard questions about what you truly own and why. For cash holders or short-term treasuries, the message is clear. Doing nothing has a cost. Inflation is eroding your purchasing power, even if nominal prices look stable. The signals are there for anyone willing to look. Silver spiking to $117 recently, now at $112, $113.